set up in the most optimal way, click the link in the video below to apply. Now, let's get into it. I talk to hundreds of new business owners every single year, and the most expensive mistake they make is being in the wrong entity structure. In fact, the first thing that we do is make sure that they are in the right one. And this can save them anywhere from $5,000 to $25,000 every single year. So, what are the three tax designations? Number one is corporations, number two is partnerships, and number three, sole proprietorships. And if you're wondering, what if I'm an LLC? Well, you can actually choose any of these three tax designations because an LLC is simply a legal designation. It has nothing to do with taxes here. Like I said, my team and I have been doing business taxes for 10 years and save an average of $10,000 for every single business owner that we work with. By the way, if you want us to personally look into your business and make sure that it's set up in the most optimal way, then click the link below to apply. Now, let's get into it. Now, the first designation that we want to talk about is corporations, but specifically S corporations. Now, we hear all the time from all of our friends from social media that we should be S corps because they save us in taxes. That is partially true. But in today's video, or this portion, I'm going to show you exactly who it is for and who we recommend it for in our firm today. So there really are three characteristics or three things that we're looking for in our firm before we tell somebody to be an S corp. The first one is you have to be profitable as a business. Now, what do I mean by that? We want our business owners to be making at least $80,000 a year in profit. That's all of your revenue, less all of your expenses, everything that's left over. If you're under that, we don't recommend it. Now, second thing that we have in our office, and this is a little bit unique, but this is why people like working with us, is that we actually only want S corps to be owned by one person. Now, they can be owned by more than one, all the way up to 100, but we prefer that it's by one person, and you're going to learn that in a little bit. And the third thing that we want to do is we want to make sure that your profit is that $80,000, it's sustainable. For example, if you're yo-yoing every year like like a bad football team who's really good one year and really bad the next and up and down, that doesn't make sense. We want you to be consistent, back to back, be earning at least $80,000 a year before we even recommend being taxed as an S corporation. Now that we know who they're for, we want to know what exactly do these S corps do? Because I hear a bunch of stuff and how it helps me and it gives me a W-2 and all this stuff, but what do they actually do and why do people choose them? Well, simply said, you save in taxes. You can save anywhere between, like we said in the intro, anywhere between $5,000 and $25,000 per year in tax savings. And that's really the big thing is that it helps you save in taxes. But which taxes exactly does it help you save? And you're going to hear a lot of stuff like self-employment, FICA, Social Security, Medicare. I'm here to kind of clear up and give you more of a broad overview of what it saves. It does save what's called self-employment tax, but I always kind of tell people as a rule of thumb is that S corps overall they're going to save you about 8 to 12% in taxes based on your profit. So if you have a $100,000 business, you're probably going to save somewhere in the neighborhood of 8 to 12% in taxes after all is said and done. That's kind of the back of the envelope rule of thumb that you can go with. Now that we know taxes save you 8 to 10%, maybe 5 to 25%, or 5 to 25,000 depending on where you are, we need to know kind of some of the cons and who this is not for. Now, just like this says, there is no such thing as a free lunch. The IRS isn't going to give you this $20,000 tax break for free. They're going to make you work for it. Now, why we talk about why you have to be profitable as an S corp and why we want to make sure that it's consistent are really for a few things. Number one, when you elect to be taxed as an S corporation, as a designation, you are going to have a lot more compliance on your hands. For example, when you are an S corp or when you own an S corp, even if you're the only employee and the only person working in the business, you have to take a payroll check. You're going to give yourself a W-2. Now, we recommend that you hire a company to process your W-2. Think ADP, Paychex, Gusto, one of those services to process your W-2 so that you can pay in the right amount in Social Security, right amount in federal taxes, state taxes, and file all of your tax returns. That, of course, costs money. Probably going to be anywhere between $500 to $1,000 a year. So like I said, there's no such thing as a free lunch. Next, you're going to want to you're going to want to work with a bookkeeping software. We recommend QuickBooks. There's tons of them out there, but you're going to want to use QuickBooks because now that you have a W-2 that you're paying yourself, your tax reporting just becomes a little bit more complicated. You have to have what's called a balance sheet. You have to file a second tax return. The reporting just becomes a little bit more complicated, and you're going to want to use a software. Do not use don't use Post-it notes. Do not use Google Sheets or anything. Use a proper bookkeeping software. And again, this is probably going to cost you in subscription fees somewhere around probably $500 to $1,000 a year. In addition to having more expensive software that you have to have, another thing is what I want to call restrictions. Now, you'll remember in the top of the video I talked, or top of this topic, is that we only recommend having one owner. The reason is that you have these restrictions. For example, as an S Corp, your partners can only be American citizens or American residents. Basically, they have to have a social security number. And you can only have up to 100. So those are two restrictions. Another one is that if you want to pay yourself extra for profits, let's say you want to take a distribution at the end of the year, well, if you take one, your partner has to take one. So there's just all these restrictions that yes, you pay less in taxes, but it just makes things a little bit more difficult. So you have to save a lot in taxes to be able to put up with these restrictions. And lastly, one of the other things is you're going to have to hire a CPA or an EA or somebody much more qualified to prepare your return, which can be expensive, anywhere between $1,000 to $2,000 to prepare just the separate S corp return. So going back to this, you want to make sure the tax savings are worth the squeeze. So if you're only saving $2,000, but you're picking up $4,000 in extra expenses, well, this doesn't really make sense for you. So again, you want to make sure that you're making a profit consistently and following all of those criteria that we have in our office. That's why the biggest mistake around S corps I see people doing is doing it too early, meaning filing for an S or becoming an S corp or getting or choosing S corp status when you're only making $20,000. That's one of the biggest ones. All this structure, it should follow your profit, not the other way around. Now that we know who S corps are for and who they make the most sense for, let's jump into the second tax designation, which is partnerships. And you want to ask yourself, who is this for? Now, partnerships isn't really something that you choose. It's something that kind of happens to you or is bestowed upon you by the IRS. When you own a business and you have one or more partners, so there's two people at least, you are designated as what's called a partnership. Now, it doesn't matter if you have two or if you have a million, they're a partner. And this actually is less restrictive as an S corp. You can actually have foreign partners. So you can have a corporation, you can have an S corp be your partner. You can have anybody in the world be a partnership. So it is a lot more flexible. And again, the IRS designates this to you right away. Now, the first thing that I do worry about or bring up with clients when it comes to partnerships is I actually really don't worry about taxes at first or profits, much like in the first example, because S Corps, you're only going to make those, or I think it's smart enough to make them when you're making enough money. The first thing that I do talk about with partnerships is who put in the most money, kind of like here, who put in the most money. When you have a partnership now with somebody else, you want to make sure that you are tracking who brought in money and who didn't. Maybe one of you put in all the money and the other person brought like the experience. Maybe one person's doing sales and one person's doing fulfillment, right? We want to make sure that we have how much money was put in by each person and who's doing their roles. Now, the second part of partnerships that I worry about is kind of like a football team here. This is a picture of Kirk Ferentz, one of the, or probably the best coach in Iowa history, and maybe even the winningest coach in Big Ten history. And he runs a good football team. It's much like a partnership. When you look at football, if you guys are American football fans, is every single player on the field has different attributes and different skills. For example, if you are a quarterback, you can throw the ball really well. If you are a running back, that means you can run really fast. If you are a receiver, you can catch the ball. It's very hard to find somebody that can do everything really, really well. So if you had a field full of running backs and your running back was trying to throw a pass, it's not going to work really well because everybody's doing the exact same or has the exact same skill sets trying to do different things. It's the same thing with a partnership. You want to make sure that your partner, whoever they are, picks up the slack that you don't have. For example, in my firm, my business partner, he's really good at sales, talking to people. like really managing the business. I'm better at doing stuff like taxes and actually doing a lot of the fulfillment work and explaining this stuff to you guys in videos. So we have our roles. Same thing here in a partnership. When I meet with people, I want to make sure that their common or their skills mesh well together. One, selfishly for me, because if they're going to be successful, that means I'm going to be successful because broke businesses don't pay taxes or file tax returns. Only successful ones do. And also, I want to make sure that they're going to be happy, that I'm not going to be their therapist. So again, you want to make sure that you are partnered with the right person. Now, one of the positives about a partnership, kind of like we talked about how you can have all these partners, is that it is really flexible. Now, if we go back to the S Corp example, where it's very inflexible, meaning you can only have American businesses. Only individuals can own S Corps, so no businesses can own S Corps. Um, if you take a distribution, your partner has to take a distribution. All these restrictions that you have to take a payroll check. The partnership is actually the antithesis of that. Now, what do I mean by that? You can have all kinds of partners, businesses, trusts, estates, 401k plans. You can have all this stuff, or maybe not them, but you can have all of these different partners and it's very flexible, right? One of the flexibilities that I like in partnerships is that you can pay yourself kind of whatever you want. So, for example, let's say you have two partners and one partner was really busting his ass the whole year and the two were just kind of passive. Well, the busting ass partner, he can take a ton of distributions. The other partners can take zero. In an S Corp, everybody has to take a distribution or a payroll check, right? But in partnerships, you can do anything you want. Now, there are two businesses that I really think that partnerships make the most sense for. Anything with real estate, think like if you have partners like real estate flipping, rental real estate, anything with that. And the second one is businesses with a lot of debt. So, example, like real estate, you're gonna have a lot of debt because you're financing projects, homes, all that stuff. The second one is anything with a lot of equipment tends to have a lot of leases, tends to have a lot of loans. So any business that is debt heavy, that's for another topic. Now, along with the positives of being able to pay anything you want, one of the of that is it does give you everything. It gives you a lot of freedom, but with that, you want to make sure that you have a partnership agreement. Now, what do I mean by that? Is partnership agreement kind of what it sounds like. Have a written document that has everything. How much each person put in, what the duties of that person is going to be. So for example, if one person's doing sales, that person is going to focus on sales. The other person is going to focus on fulfillment, things like that. You how you started the business. You can also drop the divorce papers. Now, what do I mean by that? Is inevitably partnerships are going to fade. It is what it is. People die, they move on, they get jobs, they have kids. It's kind of like a marriage, right? You're not going to stay the same. Like the person I was at 21 is not the person I am at 37 or 38, right? It's completely different. So it's going to be hard for a partnership to stay the same when both people's lives are going to change. I wasn't married. I wasn't married 3 years ago. Now I am, right? Some of my friends have kids. Life circumstances are going to happen. With that being said, you need to make sure that you have an agreement about how an exit's going to happen. And you can really draw this up any way that you want, but you want to make sure it's written down and both people have agreed to it. And again, it's one of those, it's a pro or a con, depending on the way you look at it. You want to make sure that you have this stuff written up. And that's really where I focus on tax wise with business owners, right? I don't really focus on the taxes too much. I want to make sure that they understand what's going on because you have two people in here. And the last thing I will say about one of the misnomers of taxes and partnerships and really kind of being self-employed is that when you pay taxes on the money that you earn, whether you take it out of your bank account or not. And that's one thing partners do not realize. Now, the last designation that we want to go over is what we want to call sole proprietorships. And really, sole proprietorships, they're more like side hustlers, is what I would want to call them, right? Somebody that's doing a little bit of everything. Somebody that's working for themselves, kind of like this person here. Now, again, who this is perfect for is people that are just doing things on the side. Like if you're driving for Uber, if you're maybe, prepping taxes, 2 or 3 times a year, something like that. Something that's not going to make a lot of money or under 20 to 30,000 is what I would say. Now, when I want to talk about sole proprietorships from the IRS standpoint is that when you're starting a business, you are automatically what's called a sole proprietor or disregarded entity, or that's more of an LLC. Is everybody starts out as when you first start making it. And this is perfect again for people just starting out or people who are just kind of doing something to make some money on the side. Your tax situation is actually really easy because it's just one form on a tax return, right? Or one extra form where you just put all your income and all of your expenses. You don't have a balance sheet. You don't have to do payroll. You don't do any of that stuff, right? It's very, very easy. Now, when I am meeting with people and I am looking at sole proprietorships when people first start making is I want to inevitably look at that glass ceiling. Because again, who sole proprietorships are for? It's for those people that are just starting out and they're making under $30,000, where I would say is before I even want to talk about bringing on partners or becoming a corporation, is I want to look at kind of that glass ceiling that they have. We all have it. We can only work so many hours in the day, but I want to see kind of where they're at. For example, I have a client that does dog walking through Rover, and I don't. I think he charges like $30 an hour, and he does it after work, and he does it a little bit on the weekends, like in his spare time. So I inevitably know that if you're only working 10 hours a week, you're only going to make so much money, maybe $15,000 a year. So even if he has an LLC, I'm not going to tell him to do all this stuff on the side, right? I'm not going to tell him to be an S corp and do payroll, all this crazy stuff, because I look at it and I think your glass ceiling is very, very low. It's just you're never gonna make enough money to justify that. However, let's say you are a high level consultant and you are making, $200 or $300 an hour. Now I'm going to start looking at this and think, all right, this can scale really easily. This can be something big, right? It could replace your full-time income. Maybe you want to hire people to help you out. So I want to look at that right before I'm doing anything. And then that goes into here. If you are making a bunch of money as a sole proprietorship, well, now maybe we do want to upgrade you to be an or upgrade. We want you to elect being an S corp and all this stuff, right? But it first has to be making sure that you have enough money, as we talked about in the past, to make it. But in terms of this, sole proprietorships, they're really, really good for people that are just starting out, and they're probably really bad for people that are starting to make a good amount of money. Now, where that inflection point is, again, for an S corp, it's $80,000 or what we have here in our office. But if you as a sole proprietor are making $30,000 to $40,000, that's when you want to start looking at and start to prepare these things. So maybe that means opening up an LLC, starting to invest in a bookkeeping software, working with a CPA like us to start to prepare you for this stuff. Because again, you don't want to be smacked in the face. You want to start preparing it because really at $30,000, $40,000, now it's becoming, or if I just pour a little bit more gasoline on the fire, I can make this actually worth my while. Now, now we've gone through all three of these, let's go back to where you are watching this video. And again, as I zoom out here on my mirror board and you see all these steps of everything that I've done, doing this stuff your stuff, doing this self your stuff, or doing this stuff yourself, sorry, I'm kind of misspeaking here, that's a lot. Could you do it? Sure. But in reality, when we're talking about $25,000, $30,000 and really getting these big tax savings, you want a CPA to work with to have us do this stuff for you. Now, if you want us to do this, make sure you click the link in the description of this video, apply to work with us, and we will get you on the straight and narrow, and we will take care of this stuff for you so you can go back to making money. See you guys on the next video.